नौ नगद तेरा उधार. Today we are going to discuss about net present value. We already discussed basic things about in my previous videos. So in corporate finance there is fundamental and this concept is net present value. Net present value is very important concept, and if you understand it, this is going to give us how a project is going to be beneficial for us or not. So that concept we are going to discuss into the net present value. Okay. So what is this नौ नगद तेरा उधार? नौ नगद तेरा उधार. If you meet with any person who belongs to India and who know Hindi, this is very famous saying, "No nagad tera udhar." It means, give me 9 rupees today instead of paying 13 rupees afterwards. Afterward, we do not know, because if I say something to you, I want to purchase something from you, I can pay 9 rupees today, and I don't want 13 rupees in future. So instead of taking a promise that you are taking my asset and you are not going to pay anything right now, but 13 rupees you are going to pay me in future. Instead of, this is very famous saying from our ancestors. They used to say, "No nagad tera udhar." It means, give me 9 rupees today instead of giving me a promise for paying 13 rupees in future. So how this concept is basically mapped with the business fundamentals, net present value, that we are going to discuss it today. Okay. Again, if you want to know all details, definitions, etc., I have put certain links in the description. You can open that and you will get the definitions. So what is net present value? Net present value is, suppose you are going to get a money in future or cash flow in future. So in future you are going to get cash flow, but what is the value of that cash flow at present time? That is your, basically that is your known as present value. And net present value, NPV is going to give you basically total earnings from that project which is projected. For example, NPV equal to present value minus initial investment. That is going to give you the NPV. And how NPV and IRR, these are going to help us, that we are going to discuss here. Sorry, my marker I am going to change. Okay. So, for example, you are a owner of a transport company and these are to your investment. I am going to take this. This is also, this is a mini truck. I am going to categorize it as a car 1 for sample explanation here. And this is your car 2. So for example, you are having car 1 and car 2. You are going to purchase these two cars for 5 years. Okay. In 5 years, from these two cars, how much benefits you are going to derive? We have already explained. What are the assets? Assets are something which are going to give you the benefits in future. So suppose you want to investment in these two cars, okay, as a transport company owner, and these cars are going to give you certain cash flow. How these are going to give you cash flow? For example, these cars are running, they are going to take passengers from one place to another place, they are generating certain cash flow for your transport company. Then which car you want to purchase, where you are going to invest, that things you are going to derive from the NPV. Okay. So two concepts are very important. One is NPV, another is IRR, Internal rate of return. Internal rate of return is very simple. If you are going to consider IRR and NPV in Excel sheet, this is very simple formula which I am going to show you with the experiment at the end of the lecture. So what is NPV? NPV is FV divided by 1 plus R to the power N. Okay, where FV is our future value. Future value. R is rate of return. Rate of return. Or sometimes people used to say discount rate also. N is number of years. How many years you are going to do this calculation. Future value. This also known as the cash flow. Sometimes people used to say cash flow value. Cash flow value in future. So what is this internal rate of return? If you have already gone through the basic concept of compound interest, in compound interest mathematics it is clearly described how your money is going to increment in future. Like the formula for compound interest we used to having A equal to P bracket 1 plus R upon 100 to the power N. What is this showing? This is showing the net value of when you are going to take a compound interest from a company or from the bank or a borrower. Your money is going to increment with this formula A equal to P bracket 1 plus R upon 100 to power N. But here NPV is going into something reverse. What NPV is going to be reverse in, that I am going to explain. So for example, if you have taken 10,000 pounds investment, okay, 10,000 pounds you are going to give investment, and this 10,000 pound initial year we are going to take as an investment, so minus symbol is going to be derived here. Now suppose next year at the end of year 1 C1, okay, you are going to get a cash flow of 5,000 from here. So what will be the value of this 5,000 at the present? Okay, that is the concept we are going to use into NPV. Now 5,000, when you are going to derive the value of 5,000, suppose we are taking the rate of return as 10%. Okay, then at the end of C1, what is the value of 5,000 at year 0? At means present. So at present the value of 5,000 will be according to this formula, 5,000 divided by 1 plus R2 to the power N, and where N is the number of years. Okay, and this combine 1 upon 1 divided by 1 to R to the power N. This is known as typically discount factor. This is known as the discount factor. 1 divided by 1 plus R to the power N, where R is the discount rate, or we can say rate of return. Okay, so discount factor is 1 divided by 1 to the power 1 plus R to the power N. So what will be the value of this 5,000 in present? That will be like 5,000 divided by 1 plus R, that is your 10 to the power N. Here number of years is 1 only. So 5,000 divided by 1 plus. So that value will be 5,000 divided by 110. Okay, this will be your present value of this cash flow which you are going to get in future. Okay, so you are going to get 5,000, but at present the value of 5,000 is less than the actual value which you are going to receive in future. This is due to inflation, and other factors which we are going to consider into account. Now what will be the, suppose in second year C2 you are going to get 2000. So what will be the value of that 2000 at present? 2000 divided by 1 plus r 10 2 to the power n. Here n equal to 2. So the value will be 2000 divided by 110 2 to the power 2. That will be your again present value. So what happened at the end of, suppose at the end of 5 years, C1, C2, C3. So at the end of 5 years, C1 plus C2 plus C3 plus C4 plus C5. Whatever value you are going to get, that value is known as the present value. And that present value, when you are going to deduct initial investment from present value, that is going to give you net present value. Net present value, that is the basically your how to say profit from the project which you are going to gain from this. So NPV is going to give you the value which is going to decide whether this car will be beneficial for you or this car will be beneficial for you. How this NPV is going to work, we can calculate either using this formula or by the Excel sheet. In Excel sheet I am going to derive in front of you in next few minutes, okay, in Excel sheet. Now what is IRR? IRR is internal rate of return at which we are going to say net present value equal to 0. So IRR is the rate of return at which you are going to get net present value equal to 0. That is the definition of IRR standard. IRR is the rate of return at which you are going to get net present value equal to 0. Now if you are going to calculate IRR for 1 year, then there is a simple formula for IRR. That is, like suppose you have invested 10,000 starting and you are going to gain 12,000 at the year of 2. Then this is your C0, this is your C1. You are going to calculate IRR equal to C1 minus C0 divided by C0. That is 2,000 divided by 10,000. 10,000 you have initially invested. You have earned 2,000. So what is your IRR? Just divide, okay, into 100 to take it in percentage. So that will be your 2 upon 10 into 10%. So that is approximate 20%. 20% is IRR here. If you are investing 10,000 and you are going to get 12,000 at the end of year 1, then your IRR will be this. But believe me, there is no formula for calculating IRR, standard formula as per my knowledge. For IRR, if for 1 year you can apply this formula, but like in the case of these cars, we are taking the return for 5 years. So for 5 years there is no standard formula for deriving IRR. Then you can put IRR in Excel, okay, and in IRR in Excel you are going to give all the values including these values, initial investment and future cash flows, and this is going to give you the IRR of that project. IRR is always not mentioned in terms of when project is going to be calculated, defined. IRR is always not visible, but NPV is most of the time is always given to you. Now for these two cases, I have I am going to calculate now in Excel sheet how you are going to get NPV, how you are going to derive IRR for both the cars, and based on that I am going to explain you further which car car 1, car 2, which car is going to give us more benefits in future, where I have to invest, that you are going to see in my Excel practical session. You can copy these steps as it is in your Excel sheet, and you try to derive NPV and IRR for different projects as same steps which I am doing. Make sure in Excel sheet, when you are going to do the NPV calculation, do not take the initial investment in account. Initial investment you can put in minus, and then in last, whatever your present value comes, you just manually add this initial investment C0, and then finally for calculating NPV, you do present value minus C0 initial investment. So you are going to get the proper NPV value of that project. That is you are going to follow in Excel sheet. Thank you. If you have any questions, any doubts regarding NPV, IRR, you are not able to get it properly, you can comment on the video. I will help you on that. Thank you. Okay, so today we are going to talk about okay, so you have already gone through the starting, where I have explained about the net present value, IRR, and how we are going to calculate. So I'm going to tell you this in detail in Excel sheet, how you can calculate the net present value. So present value formula and calculation, this you can see here. Present value equal to future value divided by 1 plus r to power n. If we understand here, for future value, r rate of return and n number of periods. Okay. So here for example, okay, now in Excel sheet you can see it clearly as I have displayed in model, car 1 and car 2. And if you are owner of a company, you are going to purchase these two car 1 and car 2. How you are going to select that which car you should purchase? I'm not going to take here consideration what is your investment capacity, whether you are able to afford this 10,000 or you are able to afford this 12,000. Those are standard parameters. That is again the first answer in corporate finance when you invest, that it depends. But I'm only going to take here the future cash flow and net present value, how we are going to calculate from the conceptual point of view. Okay. So here C0 is the investment which you have invested into first year in the cars. Now suppose I'm going to take a rate of return 12% from this project. Okay, standard. Now fifth year, first year, when you are going to apply NPV formula, make sure you are going to exclude first year investment here, and then we are manually going to calculate. So what we are going to do here, I'm going to type here equal to and quickly NPV. Okay, this is the formula coming NPV. Now rate, I'm taking here rate 0.12. Make sure you are going to put the rates in 0.12, like 12%. It means 12 divided by 100, which is making your 0.12, and value 1 to value 3. So here I am going to take the value from investment from 1 year to 5th year, whatever cash flow I am getting, so that I have dig and drop, and this is I am going to get the net cash flow. You are going to be surprised here, this net cash flow is coming, it is not coming the sum of 2000, 100 and 200 and sorry 2000, 1000, 2000, 3000, 2000. It is coming according to this formula. Okay. Now similarly I'm going to take here NPV equal to NPV. Okay, and make sure you are going to properly use these formulas in your Excel sheet. This is just to make sure you understand NPV, how this is going to be calculated. Now value 1 to last, so I am going to select all these. I have intentionally left the initial investment, which is our this one. So what will be my NPV? NPV from the project equal to this, which we have calculated, that is our CB8 plus, I'm not going to subtract here because minus value is minus sign is already taken care here. Okay, so that's what I'm using, plus equal to, and then this one. Okay, so here you see this Excel by default uses the bracket and red symbol. It means here NPV is minus 2952.12 and here NPV is 918. So overall, if you want to purchase car 1 and car 2, your answer should be yes, you are going with this because your car 2 is giving you the net present value of 918 and this is going to give you negative. So you are going in loss here. Now how you are going to calculate IRR, that I am going to tell you quickly. For IRR, internal rate of return, you just put IRR. Okay, now I didn't put anything else, so it is asking for the values. Now it is asking for the IRR calculated, it is asking for the values. Normally, if you are going for the 1 year IRR calculation, it is internal rate of return, very simple. For example, if you purchased a car in 8,000 pound and if you are selling in it 10,000 pound, then your internal rate of return is 10,000 minus 8,000 divided by original cost 10,000. But when you are having couple of years, this is always better to use a formula in Excel sheet. So IRR equal to values, comma, guess. So I'm going to forget about guess. I'm going to use values. In IR, make sure you are going to use the initial investment also. Okay. So this is going to give us IRR 0. And you can see here in this formula, we are going in the loss. Now, again, I'm going to apply here IRR. Okay. Sorry. Double click IRR and the values. This one. Here you can see we are going to get IRR 15%. Okay, so 15% return you are going to get from this. So from both perspective, IRR and NPV, car 2 is better. So you should invest into the car. Make sure you remember this formula very well. Whenever somebody is asking you the present value of present value of an asset, you always see all the future cash flow generated by 1 plus r to the power n, and rest is explained here. If you have any questions on it, just put in comment, I will help you on it.